and welcome to Financial Intelligence. In this video, I want to talk about Cathie Wood's take on US inflation. Cathie Wood is the founder and CEO of ARKinvest. Due to the market-beating returns of the ARKinvest ETFs, Cathie Wood has become a closely followed investment icon. That is why I was surprised to learn that Cathie Wood is not worried about US inflation. In this video, I want to share with you 3 reasons why I think Cathie Wood is wrong about inflation. If you like the type of content that I provide, subscribe to this channel and give this video a thumbs up, and also hit the notification bell so that you won't miss any of my future videos. These days, US inflation is a hot topic and consumers are continuing to feel the pinch of spiking inflation. Investors are also concerned about the impact of inflation on their portfolio and are continuously looking for ways to hedge against inflation. However, Cathie Wood thinks differently about this matter. She actually thinks that the most imminent threat to the US economy is deflation and not inflation. In a recent article and follow-up interviews, she has laid out her perspective on US inflation and why she thinks that US inflation is not the biggest problem for the market. For instance, she points out the impact of the exodus or the Great Migration from the very high rent areas of the world to much lower rent areas. She has stated that the cost of living, including rents in cheaper states in the United States, is anywhere from 20% to 40% less than in big cities such as New York City. Therefore, Cathie Wood believes that individuals and companies flocking to more affordable areas of the country should keep inflation at bay. While these migration patterns do exist and will have some impact, there are stronger forces at play that contribute to higher inflation in the United States. Here are the top 3 factors in my opinion. Factor number 1, excessive money printing. The Federal Reserve is America's central bank, and its job is to manage the US money supply. The current monetary policy in the United States is expansionary, which means artificially increasing the money supply and lowering interest rates to near zero. As a result, the growth rate of all the dollars in circulation, in other words, the M2 money supply, has soared to a historic record 27% from 2020 to 2021. To put that in perspective, that is the biggest jump in the money supply in America's history. That is bigger than the financial crisis of 2008, which was 10%, bigger than World War II, which was 18%, and bigger than FDR's stimulus to fight the Great Depression, which was 10%. The US government has gotten into the destructive habit of printing money. The floodgates are open, and it is very unlikely that this expansionary trend would reverse anytime soon. For this reason, it is very likely that inflation is here to stay. Factor number 2, supply chain disruptions. The American supply chain has so far failed to respond quickly as businesses rush to restock pandemic-depleted inventories. One of the main factors is the delays due to continuing backups to unload cargo ships at various ports. Increased demand for consumer products, COVID-induced disruption to container ship schedules, and the shortage of port workers and truck drivers have all combined to extend waiting times at ports. Globally, there are now 584 container ships stuck outside our ports, nearly double the number at the start of the year. Shipping bottlenecks, a shortage of shipping containers, and various other factors have caused the ports on the west coast of the United States to extend wait times, which trickles down the supply chain to drive up demand and prices. For example, with the current work schedules, the ports of Los Angeles and Long Beach, California, are operating at 60 to 70% of their capacity. As a result, more than 60 ships are lined up to dock, with waiting times stretching to 3 weeks. Factor number 3, labor shortage. Employers have faced a number of challenges throughout the COVID-19 pandemic, and most recently, they are facing a labor shortage. As of the end of June, the Bureau of Labor Statistics reported a record high of more than 10 million job openings. As of the end of July, 8.7 million people were either without work, currently available for work, or seeking work, creating a disconnect in the labor market. In order to fill the existing openings, employers are trying to find ways to incentivize workers to apply to jobs and accept offers. This is indeed putting significant upward pressure not only on wages but on consumer prices. In order to protect profitability, companies will have to pass on the additional costs to the consumer, adding to inflationary pressures. I hope that you like this video. If you have any recommendation or suggestion, add them in the comment section below. Don't forget to like this video and subscribe to this channel and hit the notification bell so that you won't miss any of my future videos. Thank you and take care.